Welcome back to the Winning Wealth Podcast, episode number 3. Today we're going to be talking about the apartment building from hell, aka our first syndication. It's going to be a fun one. A lot of lessons here, folks. All right, dude. It's been a long time coming with this one. I know we've, I've kind of jokingly told people throughout the last few years that someday this is going to be a hell of a podcast episode, and here we are.
It's a good story. It's a good comeback story.
It's a comeback for sure. It's the 89 unit apartment building from hell. And I mean, I got to tell you, this is, I got to hand it to, I'm usually Mr. Positive, optimistic. But this is a story of resilience. I got to hand it to Brock. He was never phased. There was a lot of times when I was thinking, shit, we're going to be out of this business before we even got started. And, but that, this is really the story of, resilience in managing and operating an asset, against considerable headwinds, and just finding out and doing whatever it takes, finding out whatever you need to do to make sure that you do right by your investors, you do right by the tenants, and you figure out how to make lemonade out of lemons, I think they say. And
I agree. So let's set the stage a little bit for this story. So we all, to keep it quick here, we all started with our own portfolio of real estate, right? We all bought some properties all on our own, right? Myself and Jeff came together through networking, decided to partner up on some deals, through bigger pockets. And then, long story short, brought in our third partner, Adam, and us three came together and decided to tackle this 89-unit apartment building through the method of syndication, right? So we're bringing in other investors alongside us. So it wasn't just our own money at play. We had investors in on the deal to go out and syndicate this property. So this is the first deal we do, 89 units.
Yeah. And also, this is not like we were, so as Brock said, we weren't inexperienced, right? Adam had a property management company that managed, probably 500 units at the time. He personally owned a lot of real estate. We each owned a decent portfolio of real estate. We joined kind of a national mastermind around buying apartment buildings and executing a value add strategy. We kind of did, Adam and I did a deal with this 34 unit deal that was, we were going to kind of, rinse and repeat those same strategies with this one. And it all felt like it made sense. But there's a lot of learning lessons here, and I look forward to going on other podcasts and talking about it too. But so where should we get started? So Brock and I and Adam decided to partner together, create Smart Asset Capital, which is the private equity sort of division of Adam's got Smart Asset Realty and the property management company, which have both grown tremendously since then. This is about
2019.
Yeah, did we close in May of 2019?
May 2019.
Yeah, so this is literally 4 years ago.
Mm-hmm.
And, we're looking for deals. I think we've been looking for deals for like 3 months or so beforehand. I mean, the thing is, I would tell everybody that you should really look at more deals. Look at more deals. Don't get enticed by, always be looking at deals. Compare them against, each other. We, and also really try to figure out what type of deal you're looking for. We knew we wanted to buy an apartment building that had some scale, 89 units. I think it was $3.5 million. That was the right size for what we were looking for. We found the deal on LoopNet.
Which is like an exchange for the MLS for the commercial side. And generally when deals go there, right, it means it's been widely marketed, kind of out in the market for a little bit, not always, but the deal was on there, so it was a marketed deal.
There are diamonds in the rough on LoopNet. I have friends that have done really well finding deals on LoopNet. And in fact, I found that 34-unit deal on LoopNet too. So, you can find, and that one's killing it still for us. But, this one, so we basically, we get into discussions about this deal. It had been under contract, I think twice, with 2 other groups. I got some notes up here, but so 2 other groups had this thing under contract, and blew out of the deal for one reason or another, right? Probably because they were smarter than us. But they, so anytime you think about an apartment building that's tied up, under contract, about to be sold, for a duration of 9 months. That's almost a full year of the property management company kind of knowing, maybe they knew or maybe they didn't, but I think they did. They knew it was going to be sold, right? So when you're positioning an asset to be sold, a lot of times with apartments, what they do is they focus on occupancy.
Well, the bank's one that 90 for 90, they call it, where they want to see 90% occupancy for 90 days. So if you fall below 90% occupancy while it's in contract, the bank's going to get scared and start raising some alarms. So as the seller, right, they need to keep a certain occupancy level to not, piss the bank off and pull out of the deal. So they're just putting whoever they can in there because on the rent roll it shows 90% occupied. They fulfilled their job.
And the group that owned this one is a savvy group in the Midwest. I think they have 2,000 or so units at the time back then. They know what they're doing, right? And, but essentially what happens then is for the 90 for 90 thing, a lot of times they fill it with tenants that, they necessarily wouldn't want in their building if they were buying it, on the front end, right? And they're
not doing credit checks, they're not doing all this stuff that you normally would.
Shitheads are going in there, excuse my French, but they're putting anybody with a pulse in there. And, to talk about the lesson there is we learned about, physical occupancy versus economic occupancy, right? Like it might be 95%, 98% occupied, I think, when we bought it, but, only 70% might be paying rent.
Yeah.
That's a huge key. Economic occupancy, economic vacancy, physical occupancy. There's a nugget there. Please, to anyone that's looking to buy properties, commercial buildings, apartment buildings, think through that quite a bit, and don't be so excited to get a deal under contract and to close on a deal if it's not the right deal. Don't let that blind you. Now, looking back on it, I wouldn't take any of the lessons that we learned away. We ended up making our investors money. We'll get through the whole story here, but so I don't regret any of this. However, it was a lot of blood, sweat, and tears, a lot of late nights, and just a lot of stress into there. So
yeah. Well, so all right, so we get in contract. We're working with the broker.
You want to talk about the area? Let me talk about the area a little bit. Right, I think so. So I was, again, thought I was a genius. I'm like, this is an emerging market. I just had read Dave Lindahl, Emerging Markets, which is a great book. I've heard some things about Dave that I don't know him personally. Heard some not so great things about him. Don't know anyways, but he did write a great book, a couple great books, Multifamily Millions and Emerging Real Estate Markets. And I particularly like emerging real estate markets. Now, if you think about this market, there's a major university right there. There's a really good steakhouse over there. There was, some kind of hype videos on YouTube about, the neighborhood that they were calling it, with drones flying over and all these. What you're looking for a lot of times is the local city officials in the area, are they on board with trying to get that area to improve, right? And if you can buy it and kind of catch that wave and that area improves, there's a couple major corporations right around there, you're gonna catch a lot of that natural market appreciation without even having to force appreciation or do value add strategies. So
exactly. We thought the area was growing, right? I mean, it's a rough area, right? But we thought there was a little path to increase the value there. Realistically, the opposite happened, but.
And yeah, when we say rough, it's like, I mean, there is still some nice Victorian houses over there. Every once in a while, you'll see, moms pushing babies in strollers there. I mean, it's not terrible, but they're, a couple blocks away, it can be pretty terrible. It's not like D-class war zone, but it is not nice. And I would say the time that we bought it was May of 2019. Obviously, 4 years later, we know what happened. COVID happened. And so I would say throughout the last 4 years, it didn't really get any better. In fact, it probably took a little bit of a step back in my mind.
Well, and then, yeah, so all right, so going back to kind of going into this deal, we looked at it. A lot of times with these C-class properties, right, we're looking at the numbers. Everything looked great on paper, right? Like, we were looking at like a 12% return coming in.
12% cash on cash.
It's like,
cash
great.
Flow.
Yeah, like cash flow looked great. And
the
so it's
yield.
like, you build out this performer, everything's great, right? But realistically, it's like when you actually get in the trenches and operating these properties in rougher areas, there's so much more that goes in on the operation side, and stuff isn't going to go to the plan, right? There's going to be stuff that happens, and there's a lot of things that happen.
So what happened essentially was because they were filling it with bodies to meet that 90 for 90 bank requirement, right? We took over. We realized that that we had to evict a lot of people. I think we evicted like 60% of the tenants, something like that.
Yep.
And these tenants in that area, they don't go the same way that you or I would go, right? Clean it up, maybe even hire some cleaners to come in and really do a nice job cleaning it up. No, they didn't do that. I mean, they beat the hell out of it. And so a lot of our, strategy to fix up these units and make them nicer, a lot of those dollars we blew through our reserves budget, because we were just essentially trying to repair the damage that a lot of these tenants had to do. So it was a juggling act of like, shit, we need cash flow coming in. We have a solid amount of money set aside for capital repairs and maintenance and CapEx reserves. However, we did not expect to have to evict that many people at all, and two, we certainly did not expect that the unit turns would be as costly as they were.
Yeah, I mean, so we evicted, I think it was like 60% of our tenants in the first year, blew through all the cash we had set aside to get us through for the 10-year period. So quickly we were at, $0 in our bank account, with, somewhat of a stable property at that point. Like we were starting to stabilize at that point and see some good numbers.
Maybe we got to take a step back, actually. So first, two things. We got to talk about the broker, and we got to talk about the debt.
What about the broker? Start with that one.
I mean, that dude came in, slicked back hair, baggy pants, like a suit, baggy suit pants. Like he just came from like Chicago in the 1990s and rolls up in this old Cadillac, right? I mean, that's right there, right?
The baggy pants is what's
the baggy pants with the old, loafers. You're about to get fleeced. That's looking back. Now I know. And then stack the caddy on there. It's like, oh boy, So yeah, he's a nice guy, good guy. I got nothing bad to say about him other than that. I don't know if the advising on that deal was the most sound, but so that was the broker. He was trying to get the deal done. We joined this mastermind group that helps their community, buy apartment buildings, particularly kind of mom and pop apartment buildings. And then I'll just say it, Wheelbarrow Profits, Jake and Gino, they're great guys, great community. I think the world of them. But, so we were going to go do this value add strategy at this apartment, even though it wasn't necessarily bought from a mom and pop. And they were expanding their services for their community. One of the guys was like a debt broker. And he had relationships with agency debt. This deal was already a Fannie Mae loan. Mm-hmm. So they had Fannie Mae loan. I think it was assumable, but we didn't take the assumable loan. I think the rate was supposed to be even better. But the long and short of that is, the guy that we were working with on the debt brokerage side, he was really excited to try to get a deal done too. And so you really got to always be thinking, what's in it for whoever else? The broker on that side, okay, that guy's going to get $100,000 commission or whatever he made. I can't remember. Mm-hmm. But, the debt broker, I mean, everybody's got their piece. And that's why it's such a relationship business. It's so crucial to make relationships with people that you can trust. And that's why a lot of times the real estate business kind of feels like, a good old boys club where, people are just doing deals with people that they know and like and trust, and you don't have to really, so these were people that we didn't know. The debt broker, introduces us to Arbor, which is a DUS lender for Fannie Mae and Freddie Mac. They were incredibly challenging to deal with, and I don't know exactly what happened. I can't remember. I know we talked about it yesterday, but you might remember better than me, but the terms on the deal changed like the week before we were going to buy it. So we had all this capital raised. We're so excited to get this deal done and, raise the money. And we had, I think, 2 years of IO, 2 years of interest only. Okay. When I was talking about the value add strategy and taking care of a bunch of deferred maintenance and turning these units and fixing up the property and rebranding and doing all these things to make it a nicer place. A lot of times you can do that when you have interest only on the front end, because you're not necessarily you're not paying down that interest. So your monthly nut for the debt is a lot lower than it would be. So, it completely threw off our pro forma projections, like, days before we were going to close.
Yeah. We went into it behind already.
Went into it. I mean, already, like, basically, if we're running a track meet, it's like the gun goes off, and we're running the 100-meter dash, and you got to sit there, like, with sand in your, pants, and you can't even get off the ground for the first. So that was a huge headwind right off the bat.
Yeah. So yeah, that had been working against us. Like we said, we came in, had to evict 60% of the tenants, kind of blew through our money we set aside to float us through the 10 years. So we're already there. Okay, so we get through that. And now, we're at a point where we're like, feel better, right? We're like, all right, I think we did the job. Like, now we're starting to see some decent numbers. We rebrand the property from, it's called 28 West before. Now we're calling it the Highlands. We put some new security upgrades. We got a nice sign out
New
front.
Signage.
So we're like, all right.
We went and met with the other owners of the buildings in the area and just figured out how are they operating their properties successfully. I mean, we threw a ton of bodies at it between you and me and Adam and our time, as well as the whole, management company. We had a lot of people working on this, on a daily and weekly basis. And
so we're there, right? We're at the point where it's like we're starting to feel good. Then what hits next?
Yeah, a global pandemic, and nobody knew what was going on, right? But here we had this property that we, in a short order, blew through a capital reserves budget and got the right tenants in the place for the most part, got the right team on board for the most part.
On-site team, yeah.
On-site.
Yeah.
And then COVID hits.
And right after that, the eviction moratorium, right? So we couldn't evict anyone. So we had 25% of our tenants walk into that leasing office and literally tell our leasing manager there, I'm not going to pay rent and you can't do shit about it. Legit. Those are the words that, some iteration of those 25% tenants told us. So there we go, right? That eviction moratorium lasted for a year and a half or so.
Yeah.
So there's another kind of headwind for us.
I mean, you buy the wrong property with the wrong debt, and then you have a global pandemic happen. The wrong property, the wrong area, the wrong debt, and then you have a global pandemic happen. I mean, a lot of people that I know, they were doing capital calls. Me and Adam took out.
So yeah, we were going in the hole at that point, right? We have 20% of our tenants not paying rent. So what we did is, instead of most operators, right, would go out and tell their investors, hey, you need to put more money into this deal to keep it afloat.
It's a capital call.
What we did is we decided between us three, instead of doing that to keep our reputation great and with our investors, was we're going to cover it ourselves, right? So we went out personally between the three of us, took out a $100,000 line of credit to fund this property and keep it afloat.
Yep. And so we really appreciate the investors that let's talk about that a little bit too. That I know it's backing up, but our investor base was really friends and family. I mean, a lot of friends, family members, and people coming in. We had our minimum. Our strategy on the raise was a $9,000 minimum or so. That would have been one share, right, of the property, and you don't want to do that, right? Like a $9,000 minimum. Our thought was, hey, we're going to get people into our investor base, and open it up to more people. And I thought that was the right strategy at the time. I thought, but at the same time, it's a hassle. It's a lot of administrative hassles for just dink and dunk in $10,000 at a time, versus now we typically do $50,000 minimums on our deals. You're dealing with a little bit more professional people that have the ability to weather storms a little bit better. As the pandemic was happening, not only as our investors are feeling it in their own personal lives, right? And they're thinking, well, what's going on with this property? We were able to get to a point where we were distributing cash flow distributions semi-regularly, and then the pandemic hits. And then we take out this line of credit because we want to be good guys, and that's just the way that we operate. But it certainly was even more of a drag on the property's cash flow as we got into 2020 and even into 2021.
Well, 25% of the time it's not paying rent. I mean,
what are you going to do?
So we were, struggling, right, to be a positive cash flow at this property. I mean, we did a good job, I think, rebranding it, right? We cleaned it up, good on-site security. But, at the end of the day, the location, I mean, there's literally, at one point there's a dead body in the back of the property.
Yeah.
So it's like you're always working against these things, right? And it's a roller coaster.
I think he was on our property, was he? Or it was just up?
I think
it was
in
the alley, like
up
the. It wasn't a tenant of ours or whatever,
but yeah.
I mean, so we considered a lot of different things around super high-tech security cameras, which would have been great. However, it's just we didn't have the budget for it, and we didn't want to do a capital call. And so I keep getting,
I mean, at that point, so we're semi okay, right? Like it's like, all right, we're seeing a little bit, but then then another one, all right. So then we get a call, right? The boiler goes out at the property. Yeah. It's like $50,000.
$50,000.
Great, we're already in the hole.
Here's a lesson on that one, okay? The inspector that we had for that property, and that guy missed some things, and you would hope that when you're buying commercial real estate, you really want to make sure that there's some things that you don't miss, that are like high ticket items, such as your roof, such as your boiler, things that could really throw off your pro forma, right? So I still think that we could have caught that on the front end. It didn't. I mean, I go look at these boilers, I can't tell. I'm not. That's. So you got to really trust. Now the guys that we have doing our inspections are legit. They literally, the guy, one guy that we use, he does it for Amazon, flies around the country, inspects, he's like, his part of a good portion of his business goes to Amazon when he's helping them find out their new locations. He's super ultra thorough. And I just think, you can't, if you're going to do these deals, you got to deal with professionals that are very thorough, that know exactly what they're doing, and they can put together a CapEx repair schedule so that you can forecast out 3 years, 5 years, 10 years, right? We didn't necessarily have that. We had this guy saying, "Nah, I think it's good." So, some more headwinds, right? We hung in there. I mean, this was daily and weekly calls for years.
I think we're about 3 years into the property at this point. All that stuff happened within a 3-year timeline. So, at that time, we're like, can we consider selling this property?
Mm-hmm.
We've, at that point, the rent roll was decent. Can we consider going around finding the right buyer for this property and selling it? This is a question we started thinking about, right? And obviously, the value wasn't super supported by historic financials because it was all over the place. Big repairs coming in, but that was a thought. It was, can we try to sell this property now?
And so what sort of happened too, and this is why I love real estate. Even when you can make the mistakes that we did make, just learning lessons, you can still come out ahead in real estate. Our last episode, we talked about why the real estate business, why we like real estate, and it's because there's always, I don't want to say always, I don't want to talk in absolutes, but there's a lot of times there's solutions that you can figure out. And so when we had a defeasance, we had a prepayment penalty on the loan, and so we weren't entirely sure how that all worked. But the nice thing is that the interest rates started to come up, and that allowed us to kind of get around that prepayment penalty. Like we were assuming can't really sell because we're gonna have to pay $1 million in defeasance for prepayment penalty or whatever, something like that. But really, when we got into it, because the interest rates went up, how did that all shake out?
Yeah, I mean, so that was one of the tailwinds, I guess. One of the probably the only one we got was interest rates went up, right? So it switched up the loan terms we had in that deal again, kind of on the front end that changed a little bit, but that interest rates going up less than the payment we'd have to pay to get out of this deal, because essentially the prepayment penalty was you have to pay off the remaining interest of the loan term. So originally, when interest rates were low, that was $1 million number. Just wouldn't make sense to sell because we weren't going to get that value for the property. But when interest rates started going up, that number went down to $50,000 to $100,000 in that range. So then we had, now we can look at selling.
So then we can look at selling, and we're thinking, okay, do we take it to market? What's the right strategy? And this is where we talked about last time. Maybe it was the last one, or I don't know. But the the buyer, this is why real estate is a relationship game more than anything, with your business partners, with brokers in the market, with lenders, with other people that literally do the same thing that you do. Like, it's not competitors, right? It's not even really frenemies. It's like, hey, yeah, maybe we compete for deals, on certain deals, but at the same time, if you're, close with friends and, have great relationships and rapport with other people that are potentially interested in buying the types of assets that you own, it can make deals go really smoothly. And so, the person that we sold this building to is very well known, very well respected. His business model is that area. I mean, like, you drive by that building now and they got it looking like Fort Knox. I mean, they got the pergolas, they got the boulders. I mean, he's got his own shtick, and it's awesome. And that's that. I mean, he owns everything kind of like that in the area, and so it just made sense that this was another kind of tailwind of, knowing the guy that buys those types of properties, and he knows exactly how to manage them, and that's their whole business model. Our business model certainly is not going to be buying in those areas anymore. Like, we've totally switched to, looking at, Class B at a minimum. For our, I don't even want to dip into Class C, because then you can start to think, okay, is this a C- or a D+? I don't know. I know I don't want either of them. I didn't want them in school. I didn't want to be in school in general, but when I was, I knew the C- and the D+, they both suck. So same with properties, right? But if you can find a B and take it to an A-, or a B- and take it to a B+, that's a good strategy. So this guy, he was able to come in, having bought a lot of property in that area already, and basically work out a deal that we were able to give a decent return to our investors, along with all their money back plus some, and pay off our line of credit. We didn't take any fees or anything on the deal. It was basically a learning lesson that I'm thankful for. I'm very thankful for our investors, but it all turned out positive in the end. And
yeah, I mean, so yeah, 3 years in, right, we're $150,000 in the hole, and we're like, shit, what's what are we gonna do here? So, but yeah, we got a couple of those tailwinds at the end, luckily, and found the right buyer, sold it, and we, so that was a little over 3.5 year total deal cycle. Secured a positive return to our investors. Definitely some learning lessons, but I think at the end of the day, we got out of it.
Got out of it. I would not have called that, a huge win for our investors. If you look at like the returns, it did not meet pro forma, but I would say it's a win that we all got out of it. They got their money back, plus a nice, return, albeit not hitting pro forma. They didn't get the 3x that we typically target, on equity invested. But at the end of the day, if you have the staying power, which thankfully we were able to take out that line of credit, we had the management company that was able to help us. I mean, because we're vertically integrated, it wouldn't have been able to work had Brock and I went and bought a building in North Carolina and had a random property management company that we don't know. The fact is, we're sort of an extension of the Smart Asset Management Company. So we're vertically integrated, and we're able to have, daily, weekly meetings with them, and really, focus on strategy, focus on KPIs, get it to a point where it was operating, decent enough throughout all the, after all those headwinds, and get it to the point where we could take it to this buyer and ultimately work out a great deal. So yeah. I think we were in Miami when we sold the property, right?
Yeah.
We closed, did some celebrating, and
it was a good day. I think for me it was, there's a lot of learning lessons, we talked about it already, but the biggest being location, right? Like, you can't change the location. It's your parents said it to you growing up, right? Real estate's all about location. It really is.
Location.
It is. You can't, that's the first thing you have to look at, is where is it located? And maybe your play is to target those deals in those areas, right? And have a strategy like the person we sold it to. We learned as a business, for us at Smart Asset Capital, that's not our strategy. No. We much prefer, the B to A locations that we don't have to, bank on some emerging stuff happening and path of progress happening. Certainly those things are great, but we don't want to be in the operations of running these properties that are just, crazy to do.
Exactly. Unless it's your business model, you feel very comfortable in those types of areas. You have a strategy. The problem that I think about going back on it is every one of these deals, you have to have a business plan. Like if you're looking to start a business or buy a business, it's all about, having a plan, and you have to definitely iterate, right? Every week, even every day, like, new information comes to you, and you have to make choices based on that information. But the thing is, our plan was like, hey, we're just going to go in and buy this property. We're going to, do a value add strategy, fix up the units, hopefully get, $50, $75 more per unit in rent, jack up the NOI, hold it for, I think we were going to hold it for 7 to 10 years.
Yep.
Yeah. And then by the end of it, have a really good exit. And, realistically looking back, we didn't have, once the debt got thrown off, that was the first big, curveball that kind of threw off our business plan. And then, thank God we had the staying power to be able to hang in there. And thank God we had the management company that we do. And shout out to Brian and Joseph and all those guys that did so much for us on that. And, I'm very thankful for our investors that hung in there with us. We have investors that are, that are repeat investors that have, that have understood, hey, it wasn't the best deal, but you guys did what you had to, what you could to get us out of it and navigate it. And I'll tell you what, too, if you look at that deal, I don't know how many syndications we've done now, 12 or so. That one didn't go so well. We bought another story that we'll do soon is we bought an office building. Our first two syndications were this apartment building from hell, and then an office building.
That's a future story.
It is, and I'm just teasing it a little bit, but we bought it just before COVID, right? So that's our portfolio, and then COVID hits, and so the good news with that one is location. We bought it in a fantastic A location, and the thing is, what I was trying to get at though is our portfolio is really performing well. We've since in deals 3 through 12, we've really each one kind of progressively gotten better and better at what we're doing and figuring out the strategy. And I've said it a lot of times that real estate is its own education. We're investing a lot of our money and a lot of our time into building out this business, but you learn as you go. And I'm not naive enough to say that like we're gonna know everything, but we're gonna do the right things.
Yeah, I don't think I regret that first deal at all, right? Like
I don't either.
Those are the building blocks of where we're at today. Without that deal and those learning lessons, right, we went to get to the deals we're doing today and the returns we're at today. So I think that's the 89 unit apartment building from hell. Again, don't regret it, but we learned and now we're right where we are today.
That's a wrap. How far did we go?
Thank you for listening to episode 3 of the Winning Wealth Podcast, the 89 unit apartment building from hell. Hopefully you had a couple takeaways here and you don't repeat those yourself. We learned a ton from this and I hope you do too.